This next video shows you how to do one of our most common policy experiments in both the real and the nominal money markets. So, as always, we're going to assume prices are slow to adjust, and we're going to look at an increase in the nominal stock of money by 10%. Now we know in the short run this will increase the money supply and prices won't yet move because they're slow to adjust. But in the long run, the entire 10% change in the money supply will feed over into a 10% higher price level. It's going to work the same in both markets. I'm just going to walk it through in both simultaneously and put the short and the long run effects and trace it all out for you to connect the dots. So let's start by drawing a real money supply and a real money demand. It's important to remember that here it's just this, and that this is the money supply over price level. That's a big M. Similarly, in this market, it's the nominal stock of money, nominal money demand, or demand for nominal cash balances. It's the price level times same real money demand function, same real money demand function. Here it's multiplied by the price level. So before we start, just to paint the picture, normally this shifts out to the right. As prices then adjust, it crawls back to the left. Interest rates drop and then crawl back up. In this case, the money supply curve is going to move out to the right, but there's nothing else multiplying it. There's no other price level or anything. So it's going to come out here and it's going to stay. As prices adjust, money demand is going to slowly creep back out. So you'll see this come out and this slowly rise out as prices adjust, and this will drop and then slowly rise back up. Okay? So in the short run in this market, the increase in the nominal money supply increases the real money supply. So let's put a little MS here. That's a big. And the interest rate falls. It jumps down. Over in this market, in the short run, we also have an increase in the nominal money supply. That is this line. So that pushes down the interest rates. And it jumps down. In the long run, we know that prices will adjust. So in the long run, we know prices will rise by the same amount as this. It's going to pull this back down and push interest rates back up. Here, in the long run, prices will adjust to be the same as that. That's going to increase the nominal money demand, and that is going to increase interest rates. So let's look at that in time paths. So here, this is going to crawl back like that. And that's going to slowly rise back up. Over here, however, this is slowly going to rise until we reach there. So we move out to here and then it stops and this crawls back up that way. In a time path, it's going to look like this. So we have the log of the money supply, the log of the price level, and interest rates. Sorry, the log of the real money. we started in steady state, as we always do. This increased. So the money supply, this is our plus 10% change in the money supply. The price level, we know it will go to here. It doesn't change immediately, so it begins to rise like this. The real money supply, which is just capital M, nominal money over the price level, this initially increased, but the prices didn't change, so this top part went up and that stayed constant. We jumped up to here. Now the top part stays constant and the bottom part continues to creep up, and so we get this dropping back to its long run. Interest rates, I ran out of space here, do the opposite of the real money. So interest rates started here, dropped down, and then slowly rose back up. So they're going to drop down and slowly rise back up. Over here, we don't really have little money supply, real money, but we can get it because we're still going to have, let me do that one in blue. We're still going to have money, and we're going to have the price level. That's the log, natural log symbol. So you can just think of it as money and price level. So even though it's not in this graph, I can construct a real money balances the same as we get here, okay? And now I can look at interest rates as well. So let's do all the pieces we can see in the graph first. So we see those two, and we see interest rates. We're initially here. Money supply increases. This is their plus 10% change. That is this movement here. That is this movement there. Prices don't initially adjust, but we know that they will eventually be 10% higher, and so they begin to adjust like this. Now, we know interest rates drop and then crawl back up. Interest rates drop and then they crawl back up. So far we've gotten all the pieces exactly as they are over here and over here based on the same graphs. We can construct this one from these two the same that we do it here. We don't really have to look at this jump up, up, and then crawl back down, because we can see it right here. This is where we were. The top jumps up, and then it eventually returns to its old level, because it is just this divided by that. So the graphs all look the same. We'll do some other experiments so that you get a handle on this.